Jason, I'll get to you in a second. Let me just ask Tyler for some comments initially. We haven't talked to Tyler yet this morning. What do you think, Tyler?
Well, you know, I wish we'd had time beforehand. I think my pre-estimate was 215.
Oh, sure.
And I was going to say that I'm going to be looking at any sign and looking for any signs of easing, both on the supply and the demand side. On the demand side is going to be looking for what's happening to average hourly earnings and what's happening to average hours. And on the supply side, what's happening to the composition of flows into employment? How many of these new workers are we pulling from unemployment? How many are we pulling from out of the labor force? On all three of those indicators, two on the demand side, one on the supply side, I think it's some encouraging signs of a loosening labor market.
Yeah, I think the key here, the markets, if you saw the futures take off, that's because the average hourly earnings came in not nearly as hot as they had been last month. That's the key. If you're looking at average hourly earnings up, that tells the Fed that they have to really continue to push the pedal to the metal on this. You want to get to Jason?
Yep, Jason?
Yeah, so it's not just average hourly earnings in December. There were large downward revisions to October and November. Last month, there were unusually large upward revisions, now unusually large downward revisions. When I was looking at the data a month ago, it looked like the pace of wage growth was like 5.5%. Now, over the last 3 months, it's an annualized rate of 4.1%. That would be consistent with about a 3% inflation rate, which is what we're seeing in the price data. All of these data are starting to line up a little bit better. But these big revisions, the upward last month to wages, the downward this month, means, as Steve Leisman said before, I just don't trust these data as much as I wish I could. That's going to put a lot of pressure on the ECI that we get basically as the Fed is meeting for their next meeting. That's going to tell us an awful lot about what's going on in the labor market with wages and with price pressures. So, big piece of data coming up there.
Okay, I'm going to go back. Liz, we'll start at the top again. What comments, criticisms, questions?
Yeah, so as somebody who's been bearish, I have to admit that this is about as close to a perfect report as we can get, in the sense that we see wage costs coming down, jobs staying plentiful, but not entirely overheating. The piece of it that's going to be the big question mark is whether or not it breaks down to a point later in the year. So let's say late first quarter, early second quarter, where we can't really catch it. And if you look at some of the correlations between the Conference Board survey, where they ask, are jobs plentiful or are jobs hard to get, some of those indicators would say that back in March, the jobs plentiful peaked, which usually leads a peak in the labor market by about 8 to 12 months. So we could still be on the cusp of something getting weaker. But today, this is a pretty good report. I think the market cheers it.
Okay, Neela, now we've seen it. Were you surprised that Liz just said it's a really good report?
Yeah, I think it's a strong report going into the new year. But that wage data is a double-edged sword, and I want to focus on that for a minute. If you look at that number, that is well below inflation. And so for a worker, seeing their wages go down instead of up in terms of the value of their dollar, it's not a good situation if you're worried about the overall economy. And I think that is the real rub of this labor market. Even though there may be some celebration on the moderation of wages, it's not at the household level. They still need those wages to be robust to keep up with inflation. So bringing the Fed into that picture, how do they navigate the real drop, and we're seeing this in ADP data, and wage growth, the timing of that with the timing of lower inflation? You'd like inflation to drop faster than wage growth and not the other way around.